meaning for those 5 years, you're only paying the interest back. It's not like a residential mortgage where you have P&I, principal and interest. And over the 30 years, obviously in the beginning, it starts more heavy on interest and a little bit towards principal. And as that amortizes over the 30 years, welcome to the Cash Flow Chronicles. I'm your host, Jonny Catani, and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Happy Wednesday. Welcome to another episode of the Cash Flow Chronicles. I'm your host, Jonny Catani. Hope everyone is having a great week. We are now a full week into June, and summer is rapidly approaching / upon us, and a lot happening. So hopefully everyone had a great weekend. I'm excited for this episode. I'm going to give a few different updates on kind of what's happening across the economic world, and then I'm going to end with an article that I read in the Wall Street Journal that I want to go over and cover and kind of dissect, that delivers kind of it's shedding some light on something, but it may not be that bad of news as, typically you can read. And again, I talk about mainstream media and I do love the Wall Street Journal, but it's important to take a certain perspective when you read articles like this. So that's what I have for the show today. So let's roll into it. So the first thing, I imagine that a lot of you are golfers. I'm a golfer, and you probably saw that the PGA Tour and LIV Golf have merged, which is absolutely insane. No PGA players were aware of the decision. It was all the upper manager, the commissioner of the PGA, Jay Monahan, and the board. So if you haven't read about it, surprise. If you're not a golf fan, basically what it means is that, so about 2 years ago, LIV Golf was formed, which was funded by the Audi PIF fund, which is a public investment fund. And it's just this big multi-billion-dollar fund that they use to invest in a ton of different things. I believe they own a UK Champions League soccer team. They're invested in some other American businesses, American sports teams. And then, of course, the big one is the LIV Golf, which is a different style of golf than the PGA Tour. But the biggest part about it is that they offered golfers like insane amounts of money. I mean, I think Phil Mickelson got like $250 million for coming over to LIV. Other, 8-figure, 9-figure, some other 8-figure, 100 million plus offers, and then a lot of just 50, 60, $80 million offers to some of these players who, like Ian Poulter, kind of on his way out, older guy, still getting up, still in the money on these events, but, making with sponsorships and stuff, making, 10, 15, 20 million a year, not a bad living. Right. But then you get a $50 million offer. It's like, okay, well, it's pretty much guaranteed. Right. So makes a ton of sense why they take that offer. Brooks Koepka was another notable name. Cam Smith. So some very notable names are over there for some very large paychecks. And the feelings were mixed. My personal opinion on it is that I don't blame them for taking it, because you're still playing golf. They can still compete in the majors. Can't compete in any PGA events, but can compete in the majors. And the PGA was slandering the LIV name, and everybody was slandering these golfers' names because the Saudis are being accused of sports washing, meaning they're using sports to boost their PR because they have pretty horrible name for themselves publicly with they've been accused of like killing some reporters, like literally like some really bad stuff that they've been allegedly accused of. And so, they were being accused of sports washing, which is, using sports to kind of change the world perspective on their country. And the PGA Tour has been slandering their name, talking about like, any player who goes over there is never allowed back. They have to pay a huge fine if they want to come back, all these things. And then we hear that they merged. And so it's a really bad look for the PGA. I mean, really bad. It's just, it'll be interesting to see. I mean, from what I hear so far, all the players are calling for Jay Monahan, the commissioner, to be done. It's supposed to be a player-run league, meaning like they have a whole player committee that's supposed to be consulted on everything. That obviously did not happen. So it'll be interesting to see what happens for sure. So I don't know, Also, side note, I apologize for my voice. Allergies have picked up horribly this week, and we're getting a lot of storms. And when it's super windy, it just kicks up dust and everything, and I get crushed by it. So apologize there. But yeah, so this merger is crazy. It'll be interesting to see kind of how things shake up. It means that people from the LIV Tour are going to be a part of the PGA board and vice versa, but it's mostly that they're going to be that LIV Golf is going to be like involved, and they're going to be able to make decisions. The PGA is going to control most of the PGA, but yeah, it's crazy because these golfers all went and got paid and were getting shunned, and now they look like the geniuses for going and taking a payday because they're just going to come back to the PGA Tour anyway. So it'll be interesting to see. Supposedly there could be some kind of fine for them if they return, but from what I read, as soon as this season is over, they can reapply for their PGA Tour card. So I don't know. More details will come out, but it will definitely be something to take care of or to take a look at. So we'll see. All right. So moving on. Some other news. So the World Bank has made a change. I did a podcast. Shoot, this is probably back in January now, maybe February, where I talked about the World Bank and how they downgraded their outlook. So they gave an outlook in November, December for 2023. So in December of 22, they gave an outlook. It was slowing down compared to, I believe it was like 3%, like a little over 3%. Last year, we saw 3.1 global expansion. But anyways, they dropped it, and it was very significant when they dropped it in like January, February, like very bad news. They brought they believe they projected like a 2.8% increase in like December, brought it all the way down to 1.7. Okay, it was in January that they released the forecast. Brought their forecast all the way down to 1.7. Some sectors even having negative growth. But in good news, they have increased it now and are forecasting a 2.1% global expansion, which is good news. That means that, aside from what they're calling our stubborn inflation, and a lot of advanced countries like ours are also seeing the same stubborn inflation, meaning, raising interest rates hasn't reduced inflation as much as they were expecting, but all the data is starting to show that things are slowing down. The Fed obviously teasing that most likely they'll pause, and that will come out next Tuesday, Wednesday. So obviously I'll keep you updated there. But so far it's sounding like they're going to pause on this next meeting. And so because of the pause, because global inflation is starting to come down, the World Bank has decided to increase their forecast for the year to 2.1%. So that's good. It's still a slowdown, right? Last year, like I said, we saw 3.1%. So still a slowdown, but certainly leaning toward, 2024. So next year, starting to see things grow. And of course, the adage has been survive to 25, with, of course, 2025 looking like the economy, global economy, and even our domestic economy starting to really cruise back up and grow more rapidly. So again, something to keep an eye on. I'll keep you guys updated on all that stuff as the news comes out. But certainly some pretty good news to hear from the World Bank for sure. So love to see it. All right. So the biggest thing I want to get to today, Wall Street Journal article I read, interest-only loans helped commercial property boom. Now they're coming due. So 1.5 trillion, that's trillion with a T, like tango. Landlords face a $1 trillion bill for commercial mortgages over the next 3 years. So essentially what they're saying is over the next 3 years, $1 trillion in commercial loans. So here's why I want to talk about this article, because whenever you say commercial real estate to someone who's not in the industry or is brand new, they really only think of office, right? So people will read this and be like, and then here, for instance, let's say I, went to a networking event and it's like, oh yeah, I'm a capital raiser, primarily focused on commercial real estate, but we do other assets as well. And they hear commercial real estate and they think of this article like, oh, what's going to happen with the $1.5 trillion in loans due over the next 3 years? And listen, that is a factor, right? I don't want to diminish it. I just want to give my perspective here. So ultimately, what's going to happen is $1.5 trillion in mortgages are going to be due. Since 2021, interest-only loans have increased to 88%, up from 51%. So this is using data starting in 2013. Since then, it's grown. Interest-only loans have grown to 88% of loans for commercial real estate. And what interest only means is that, let's say you get a 10-year loan, fixed rate, and they give you a 5-year interest only period, meaning for those 5 years, you're only paying the interest back. It's not like a residential mortgage where you have P&I, principal and interest. And over the 30 years, obviously in the beginning, it starts more heavy on interest and a little bit towards principal. And as that amortizes over the 30 years, it starts to switch, and it's obviously the same payment because you have the same fixed rate, but that payment starts to go, instead of 80% to interest and 20% to principal, over time it changes to eventually obviously paying it all off, right? Well, commercial loans work the same way. They have a amortization schedule. Even though it's a 10-year loan, they still have an amortization schedule. And, typically you'll see a 2 to 5 year interest only. But what will happen is after that interest only pay period ends, you're now paying principal and interest, which if you're not increasing your cash flow or you're, boosting your NOI, then when that principal and interest kicks in, that's going to take a massive hit towards your NOI, right? And NOI doesn't include interest only. So it's going to take a big hit from your bottom line revenue, essentially. And so this article is basically saying that, landlords are going to be in trouble. And what ultimately will happen is that, in the residential world, it's disguised as a motivated seller. And sometimes motivation is just that they need to move. But a lot of times it's due to two things. One, you're either trying to avoid default, which makes you very motivated. Two, you are moving, but on the subject to selling your house. So the longer it sits, the longer you have to wait to move. And typically you're trying to buy a new house in your new destination. So, it can be very you can find these distressed sellers, aka motivated sellers, and it's happening more often, right? Where, you know, because the market, because houses are no longer getting, 20 cash offers over asking price, and they're sitting for 2, 4, 6, 8 weeks, prices are starting to come down because sellers want to sell. So they're trying to, so they have to lower the price. That's the only option they have is to lower the selling price. And so that's what they end up doing. And so this is what's happening here with these commercial properties is eventually you have to lower the price because you have to sell. And once you lower the price, that lowers the other commercial property in the area, which then brings the market down. So that's kind of how the full circle works when it comes to this kind of market cycle that we're in, where, when you're motivated or distressed, the entire market is going to come down, which is going to decrease valuations, which then hurts others as well. So I say all of that to say that don't take this article as, oh, this is, multifamily as well, and multifamily is going to get crushed. There are loans coming due in multifamily. This is also a concern in the multifamily space. I've talked about it before, but the difference in multifamily, and this is the point I ultimately want to make, because, I don't have my eyes on office, and there are some markets where office is still very much in play. There are employers are really pushing to try to get people back into the office, become less and less hybrid. But for multifamily, what you're seeing is, one, this is a literal necessity, right? You're talking about someone's, housing, and it's a necessity. So with office, I believe the national vacancy is still 50%, meaning only half of all office space across the US has a tenant. And, you're seeing companies downsize and move to smaller places, like all the things, right? So the difference with multifamily is that, there's going to be a market for someone to come in and buy these. Now, you are seeing motivated sellers and you're seeing asset prices come down, which needs to happen. I want you guys to know it does need to happen. We're due for a bit of a correction in terms of bringing asset prices down. They were getting out of control. You were seeing, 2x in 14, 15, 18 months. And that's just not normal. So this correction will bring us back to a normalcy where, you actually have to implement a business plan and hold on to an asset for 3 to 5 years and choose your market correctly and your sub-market correctly and make sure you're on the right block and, make sure you have good property management. And all the things that go in with actually implementing a business are going to be very, very important. And you're going to see the point I want to make is a lot of the groups that got in and just kind of rode this big wave of, like, the market just pushing everything up and it being such a hot asset that they didn't really have to do anything. And as they say, when the tide goes out, you'll see you swimming naked, because essentially now we're going to see who was able to implement an actual business plan and keep themselves capitalized enough to cover, an increase in interest rates, or, when the interest only goes away and, their mortgage payment goes up. So that's what we're going to see. And, the ones who didn't do it correctly are going to be, your quote unquote motivated sellers, right? Which is going to be a distressed seller, typically not a distressed asset, but it's distressed seller. So there you have it. That's really all I wanted to cover, but I really just wanted to make the point of, don't read too much into this in that, the whole market is going to crumble, because certainly there will be a correction and it is due to this exact reason. But again, if you're choosing the right group who has the right team in place and they've got a good track record and they get their debt right, then you're going to be fine over the next 3 to 5 years. Certainly, even assuming, 25 things start to pick up, you could start to see assets bought in 23, You could start to see some dispositions, some full cycle deals starting to go around in 25. And of course, as the market starts to move back in the other direction, we'll start to see more of those deals come full cycle. But certainly there are groups who like to hold even as the market moves up. So there you have it, guys. There's a show for today. Thank you guys so much for listening. As always, go to the cashflowchronicles.com, same name as the podcast, thecashflowchronicles.com, and join my list. I can't market deals that are 5 or 6 Bs. So if I have a 5 or 6 B, you're going to have to be on my list in order to get access to it. So there you have it. Also, please, guys, don't forget to share these episodes. If you enjoy what you're listening to, someone else out there will enjoy it too. Would love for you guys to share, rate, review, all of the things. And I hope you guys enjoy the rest of your week. And I will talk to you guys on Friday for the Friday follow-up. See you guys. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to katanicapitalgroup.com to learn more.